Hello future millionaires and welcome back. In today's video, I'm going to be going over a commonly used strategy for investing, which is called the fundamental analysis. Through this strategy, we're going to be able to find various metrics of a business, such as their earnings, expenses, and more, with the ultimate goal of finding what the business is actually worth. And if you're already confused, don't worry. I'm going to explain this all in a way that actually makes sense. And on top of this, I'm going to be providing real-world examples so you can see how this applies, well, to the stock market. And before I get started, I want to quickly clarify this is not financial advice. So any stocks that I do mention aren't meant for you to go and buy them, but rather for you to go do your own analysis and see what you think about them. Okay, so I want to start off this lesson by simply explaining what a fundamental analysis is. I'm going to explain this more in depth, and I'm going to do this with my presentation. I hope it's not too messy. But basically, the definition of a fundamental analysis is pretty simple. Imagine that what we're doing with a fundamental analysis, we're going to be looking at various metrics. For example, revenues, how much am I making? How much am I spending? What am I an owner of? What do I owe? Etc., etc. From those metrics, we're going to be able to make some calculations and find other metrics. For example, some that you might have heard of and don't understand is free cash flow. Yes, but I'm going to get more into that soon. So what we do, again, we're finding metrics. Why are we finding metrics? Why do we want to know this? Because past trends are going to help us make assumptions about the future. Now, for all of you all that are not similar with any type of active strategy, and what I mean by active strategy is you have to take time out of your day to basically be doing stuff like fundamental analysis, for example, right? There's a lot of assumptions involved. For example, I'm going to be looking at past earnings, past competitive advantages, but that doesn't mean that in the future those are still going to exist. The past can help, but it doesn't predict the future. Besides just how much do I make and how much do I spend, we're going to be looking at other stuff like competitive advantages. One that you might have heard of is pricing power, and this is usually when businesses can keep increasing the prices and people will still buy. Think of it just sort of like in the airports when people sell water, right? Or usually like very closed events where there's only like a couple of people selling. Well, those people are going to be able to charge a lot. They have pricing power. In Apple's case, I don't know if you all have seen the news, but Apple is increasing their prices, and their pricing power is going to be sort of tested, because we're going to see to what extent do they have pricing power. And it's going to be very interesting because, again, the past does not predict the future. I feel like as I go more in depth, you guys are going to understand them more. And let's get started with the three main principles of a fundamental analysis. Okay, so to start off, I'm going to go with the first principle of the fundamental analysis, which is accounting. Now, for all of those that they don't think that they have the capabilities of becoming an accountant and all that stuff, don't worry, it's not that complicated. We're going to be looking at some accounting metrics at sort of at a broad level. Not really, but yes. We're going to be looking into financial statements, and here I'm going to, already get into the first explanation. Imagine that companies every single 3 months, they have to, or quarterly, they have to release financial statements. So they have to release 3 financial statements. One of them is called the income statement. The second one is called a balance sheet. And the third and last one is called a cash flow statement. Just remember this in this way: IBC, literally income, balance, and cash flow. Okay. And if you don't understand what this is, I'm about to get to it. So imagine that the income statement is very simple. It's literally what it says in my presentation. Income statement is how much do I make and how much do I spend. I'm making $10 and I'm spending $5. Okay, yeah, sure. Yes? Our balance sheet says what do I own and what do I owe. Because, for example, say that Apple has 10,000 phones, iPhones, and 10,000 Macs just, laying around there, right? Well, those Macs and phones are still worth something, like they haven't sold them yet. And though that's inventory, that could be sold in the future. So that's considered an asset. Now, in the same way, maybe Apple, they probably wanted to buy, I don't know, more tech for their phone, say that they're, need some technology or whatever. And for whatever reason, they take out a loan. Well, that same thing is a liability. So in the balance sheet is simply what do I own and what do I owe? Because maybe, I don't know if you have seen the Apple building, it's very cool. That's also their property. So they're owners of that. That's an asset for them. So the balance sheet, all it says is what am I an owner of and who do I owe? And that's what it is. The cash flow statement is kind of where people get confused, and it's when money comes in and money goes out. For example, and this is the most simple explanation. If you want to do your more research, please do so. I'm going to be giving sort of like a broad level right now, but say that a business like Apple takes out a loan. Yes? Okay, so what happens when you take out that loan? Yeah, you owe people money, but at that instant, in that same instant, you're gonna get the money that you want to be loaned. Say that you take out a loan of 100K, 100K comes to your bank account. You receive that money. So that's money coming in. And people usually get the cash flow and the income statement confused, like, oh, but they're basically should be the same thing. At the end of the day, the cash flow is what I'm making. No, because you could, for example, take money out of the bank, like I just said right now, and you're gonna get money. As simple as that. Don't overcomplicate it. It's money coming in from, say that you sold something from a, bank transaction, and money going out. As simple as that. So where can we find these? I'm personally gonna show you all a tool that I use. You can go look for your own, whatever you prefer. But please use a tool. If you're gonna do this and you're gonna take this serious, please use a tool. Because, for example, if you go one by one, it's gonna take you a long time to, get, for example, 10 years worth of data. In this tool, come to ticker. For example, let's just say I want to invest in Microsoft stock. All I do is come over here. I come to here where it says financials. And then, for example, I can extend this. Right now it's from 2026 to 2021, and I can extend this around 10 years. And look at this. Here, where it's highlighted, if y'all see the blue, it basically, let me just move my camera really quickly. It says revenues. Yes? So basically, revenues have steadily increased. We can also see how revenues have changed. For example, 2017 they increased 5.9, 2018 they increased 14.3, 14 the next year, etc., etc. Yes. And this is basically the income statement. That's why I'm telling you. Like, let me just come in here with revenues. Okay. For example, here, let me just do this, move this one. Yes. And then eventually we're going to get into all of our expenses, interest expense, income, all of this. And then we can come finally to our net income. And that's how much, like, what's our net profit? What were we left over with at the very end? Remember, this isn't cash. This isn't how much cash did I have at the end of the year, how much did I increase? Because maybe here it says 101, but for whatever reason, I just took out a loan, or in some other way, I had a cash expense to the cash flow statement that isn't an expense here. Remember that. The income statement is here to determine the profitability of the company, but it isn't cash movements. It is not cash movements. Here it could show good stuff, and maybe for whatever reason, the business and the cash flow statement, there was cash outflows, and that were not an expense. And we turn out that this year we have less money than what we had, even though we had profit. Remember, this is not cash movements. This is just profitability. Profitability, yes? Okay. So again, this is how much we, made, like, revenues, and then what we were left over at the end in terms of profit was 101. Here, what's important to see is how our sales have been increasing and other metrics, which I'll go into later. I just kind of want to, show y'all. The balance sheet, for example, cash and equivalents, that's basically, what I don't have of cash and stuff like that. Short-term investments, just think of that as cash, basically. It's not, but just think of it like that. And then at the end, we can see all of our total assets and then our total liabilities, which, if you do not know, say that a company has $100 worth of assets liability plus stockholder equity, which do not worry about some of these names, just think about it. They must equal the same. So just think about it like this. Whatever you own, you must also owe. Okay? Just think about it like that. And I know it sounds confusing, but I'm gonna just be giving you sort of like things like comments like those. The cash flow statement, there's certain costs that aren't actually a cost. Like for example, like do y'all know how a car usually goes down in value? If you didn't, well, surprise, surprise, it does. A car goes down in value all the time. Yes? But even if that car goes down in value, you technically didn't lose money. Like there was no one that took money out of your bank account. It's just that your car went down in value. And that's what I meant in the income statement. In the income statement, because they're trying to determine profitability and there's a different goal, they subtract depreciation. So say that Apple, they have a car there. Yes? Okay. Well, that car might go down in value and that depreciation is going to be subtracted from their profitability when it didn't affect them. And that's why in the cash flow statement, we have a goal of seeing how much cash was moved, how much came in and how much came out. And depreciation is added in the cash flow statement because technically, since you didn't spend that money, it gets added back. And again, simple things like these. But I hope you kind of understand right now what these three financial statements are. There's quarterly and there's yearly statements. Right now, I'm going based off of the yearly statements. Use a tool, please, because if you want to like do this manually, I can show you how you can do this. It's, you have to come over here. And you have to do this whole long process, which I'm not going to get into right now, but yeah, you have to come into this and then you have to, for example, I don't know why it didn't work. But okay, yes, you have to do this process. If you do want to, comment it down below and I might do the video about this. Okay, so now that you kind of understand a little bit of the world of accounting, again, remember this video, I'm trying to keep it relatively short, which is why I'm not going to elaborate that much. And if you do guys, like since I'm creating this new series, I want to know what y'all want to know about. So if you want me to go more in depth into this, please let me know. I'm very willing to, and I could probably go into these concepts in a way that makes more sense, because for example, there are certain things that I'm skipping over. I'm going to be giving you very broad level information for the sake of today's video, because again, all of these are hours and hours of theory, but again, I'm going to try and simplify this the most I can. So our principles of accounting, now that you kind of understand this financial statement, we try and find various things like revenues, expenses, profit margins, operating leverage. Operating leverage is something that I'll explain later on another video, but I consider these to be relatively easy. That's why I put them in the green bar, because the green is sort of like, oh, well, I mean, yes, it's somewhat complicated to find these, but I mean, just put it in chat, ChatGPT. These other metrics here, ROIC, ROE, which is return on equity. ROIC is a return on invested capital. Very important metric. Why? Because this looks into previous, it's a past trend. So basically, say that your ROIC is 20%. That means that with every single investment that, like for example, say that Apple has a ROIC of 20% and they invest into their business $100, then they're gonna get out of there with $20 in profit. Their investment has basically, led them to $20 in profit, or 20% of whatever they put. That's a metric that basically captures, again, a previous trend. It's from the past. It's not of the future. That usually when stuff happens, like I don't know if y'all have seen that right now, there's like a lot of AI spending, and a lot of investors are selling stocks like Microsoft and more, because since they're investing so much into AI and AI isn't profitable yet, the future ROIC could be affected in a negative way. And the reason that it's a little difficult is because there's a lot of ways to calculate ROIC. All of these here that are here, there's a lot of different ways to calculate them. Free cash flow, there's a lot of different ways. Organic and inorganic growth, that could sometimes they pop up in the financial statements. But the reason that I'm telling you this is because if you do get more in depth into this, you're gonna have to learn more about these and how you can calculate them. The most difficult one, and this is kind of something that goes for everything, is a discounted cash flow. Imagine that just from these two things, we could sort of have a trend of, how much have our sales grown by, etc. and we try here to predict how much do our future earnings are going to be, how much they could grow by. We use this plus analysts, because imagine that there's analysts like that basically dedicate their life to estimating how much sales are going to go by. So we base ourselves off of analysts and also past trends. Okay, so what we do is we try and find those future earnings assumptions, remember, and we try and sort of find the value of the company through that. We say, okay, this is how much you're gonna make in the future, and now I need to bring it back to what it's worth right now. If that makes sense. That's called the time value of money. Another concept that is somewhat difficult to grasp at the very beginning. But yes, okay. So this accounting section, remember, all it is you're looking into numbers. You're going to find metrics such as ROIC, free cash flows, organic and inorganic growth. Organic growth is basically when, say that you have a Walmart, right? And that Walmart keeps growing because a lot of more people are coming into the Walmart. That's organic growth. Inorganic growth is, imagine that there has to, more Walmarts have to open up for people to go into Walmart. That's inorganic growth. And that's sort of good to look at because every single business is very different. Okay, so now we kind of got done with the accounting. I'm not going to go and explain this any further. I think it's a lot of information that is just for this section, and I'm going to go into something that's a little bit more easy, which is the business model and KPIs, or key performance indicators. So what we try and do here is, I don't know if you all have seen, but it's very important for you to understand the business that you're investing in. Some people invest into, for example, in my case, I have someone that influences me a lot to buy energy stocks. And I think he can buy energy stocks, and I'm probably going to buy more energy stocks, at least the ones that I understand. Because how are you going to put your money into something that you don't even understand? Like, seriously, there are people that just hear a trend like, oh, this is an AI company, let me put money into it. No, like, do not. For example, it sounds very dumb to understand what Microsoft sells, but since I'm an investor in it, I want to know what they sell. As simple as that. I want to know, like, okay, they sell this to these people. Yes. For example, a lot of people think that Amazon makes money through distribution. No, they make a lot of more money through cloud sales. I don't know if exactly they make more, but I know they make way more profit margins through there. And that's when people realize, wow, I can't believe this. That's where the money's at. And I thought that it was in the distribution. And once you know this, it really changes your perspective because you see where where this company could grow at, and you can kind of make more educated predictions for the future, or assumptions. Yes? Okay, that's the product market fit. The revenue model is where do they get money from, where do they sell, etc. Yes. Their cost structure, very important. Every business has a different cost structure because say that you're an AI company, you require a lot of data centers. You're heavy on capital. But a software company that doesn't really need that much, they're light on capital. They're capital light. So it's very important to know this because this tells a lot about your business. And the economic mode, there's a lot of this. There's a lot of economic modes. It could be simply pricing power. It could be some things called the network effect, a lot of stuff. But this is what I'm talking about, that you have to understand your business. You don't only have to understand where they make money from, but what are their competitive advantages? Yes? Okay, there's KPIs, or key performance indicators, for every single industry. For example, say that you have an e-commerce business. I don't know if y'all have ever heard of drop shipping or anything similar. You usually like to see how many people, like your conversion rate, how many people enter your store, and out of those people, how many, basically get turned into clients, how many buy from you, and that's your conversion rate. That metric is important for an e-commerce business, but the same way that that's a very important, there could be another metric for a industrial business or a software business. A software business is the churn rate. So you need to know all of these, especially in the company that you're going to invest in. The last thing is assessing terminal value. This is basically, in very simple terms, seeing if with these competitive advantages they can survive in the next 10 years. Because again, in the example of Apple, that they're trying to increase their prices, their pricing power is going to be tested. Like, it's going to be a good moment to see what's going to happen. And yeah, I mean, assessing terminal value is going to be an important thing that you can base yourself based off of their competitive advantages. Last but not least, I want to get into the third principle, the most underrated one out of all. I swear, people don't ever look into this, and this is literally the way that this can help your future prediction, like your future assumptions the most. The reason that it's very important is because obviously you want to know who's running the business. At the end of the day, his his management will impact your stock price positively or negatively, and that's where you're putting your money in. So technically, I mean, you should be pretty worried about what he's gonna do. So okay, let's just start off with the very basic stuff on what you should be looking at when you have with a CEO, with the management team. The tone, and are they salesmen? For example, a lot of people are trying to sell typical investors, like retail investors, into their stock. Oh, buyer. They don't come out and say buy our stock, it's super good, but they indirectly try and sell the stock. And they basically talk about buying it. I mean, if you talk about good results in the future, that isn't trying to become a salesman, but it's more than anything when you indirectly just pushing a sale, of the stock, when you're trying to sell the image to people. The second one is guidance and their track record. Because imagine that these people, under every single quarter when they come out with the financial statements, I think I'm gonna put it whenever I edit this video, but I forgot to state that there's quarterly and annually. Quarterly, they come out and talk about their results. Like there's quarterly financial statements where all of these three financial statements get released every single quarter. And then the annual one is basically the whole year, the three financial statements for the whole year. But every single quarter, what they do is that the CEO, or usually like the CFO, the important people, I'm just gonna put it like that, they come out and talk about what they expect the business, how they expect the business to perform, etc. And they do sort of promises. Because if you watch my first video, stocks are moved by expectations. So you set out a good expectation in the future, the stock goes up. You set out a bad expectation, it goes down. And what I like to look at is how often have their promises became true. Because a lot of times CEOs make promises that they're going to release this and this and this, and they promise a better future for shareholders, whatever, all of this stuff. Well, then simply check out the past and see if it's true. As simple as that. And if it's not, well, be careful and probably not invest in it. And if it is, well, good thing you have a good CEO at your hands. That's why a lot of the times people that have good track records, whenever the good CEO leaves, the stock experiences volatility. So basically, it goes up and down, because people don't know how to react. Okay. Q&A dynamics, very important. How they reply to questions that are sort of they didn't imagine they were going to get asked. For example, one of the problems that I talked about right now is AI spending. AI isn't profitable. If you've seen OpenAI, they're burning through cash, and Microsoft keeps pouring billions of dollars into them. So, for example, if they get asked questions like that, what is their thought process? How do they answer? And all that stuff. You have to pay attention to that. Then the one that's a little harder to understand. The next one is ROIC, M&A, buybacks versus dividends. Let me put out the one that I consider to be most important. It's how do they manage their money, their extra money? Because say, for example, that you have an extra amount of money. What are you going to do with that money? Are you going to invest it back into your business? Are you going to pay out dividends? If you don't know what dividends are, again, make sure to watch the first video. But are you going to pay out dividends, or are you going to buy back shares? Buying back shares is a concept that I haven't covered yet, but I'll explain a different thing. But imagine that what it does, it benefits us, the shareholders. Yes? So what are you going to do with that money? Because a lot of times they could probably pay themselves through stock and find kind of ways to not benefit us, the shareholders. We want CEOs that benefit us, that help us, not themselves. And that's an important thing to look into. Again, AI will help you with this. Okay, last but not least is, do they have skin in the game? And what I mean by this is how much of their pay is tied to stock performance. For example, if the stock performs bad, some CEOs don't pay themselves at that point, and basically that's when you see how much they believe in the stock, and that's high commitment. And if usually the CEO is committed to the stock, you can see that's a good company, and you could probably put your money in with the safety. It's not a guarantee, but it's sort of another factor that helps you out to see how it's doing. So a lot of stuff. There's a lot of stuff. And on the same topic of tools, I want to basically, again, not this tool specifically, find whichever best suits your needs. But this one, for example, Ticker, the reason that I like it is because it gives me, well, due to my subscription, I only have access to 1 year worth of, calls. But what I can do is I can come into these calls and put them into AI and see what like their future plans are. I have a system for this, but I'm not going to enter into my fundamental analysis approach yet and like my whole system behind this, because I basically create folders on Google Drive and I have like a thesis for every single one and everything. But I'm not going to go into this right now. But basically, part of what I do is download these, or at least copy the transcripts, and then I have AI analyze them. I also, what I do is I tell AI to just solely base themselves off of what I'm sending them, like these transcripts, and then I ask them questions. And the only way that they can reply to me is if the transcript, or basically they have already responded to that question. And then it's interesting how I get into the base with it and everything. But the benefits of having the tool, it simplifies your life a lot. A lot of times I feel like, for example, if you're going to get into something, you need to invest some money into it, especially when you talk about investments, because it's not that similar. Like, for example, me, that I've had like, some businesses and everything. I tell this to you, like, I tell this to you guys as like advice. Since I've had business in the past, it's very different from, creating something and then having access to these tools, which will not only simplify your life, but like benefit your results, and probably save you from losing money at the very beginning. So yeah, definitely, I highly, highly, highly recommend you get a tool. All right, guys, I think that's going to conclude today's video. I hope you all enjoyed it. I hope it wasn't too confusing. Again, I'm still learning this whole process with y'all. I hope there was still some information that you just learned. And if there was, please make sure to like and subscribe. Any questions you have, make sure to comment them down below. Any suggestions for future videos, like if y'all want me to go into an accounting, like, full lesson, I can definitely do that. Actually, one of my strengths, because I study way more, was fundamentals rather than technical analysis. But I'm gonna start getting into everything, see what works, see what y'all like. And yes, I hope, again, you enjoyed this video. Please make sure to like and subscribe, and have a wonderful day.